Framing bias is the idea that if you present the same investment opportunity in two ways, you can actually get different responses to it. So for example, if you say that this investment opportunity has a 70% chance of a win, that's actually going to lead to a different and probably more favorable reaction from investors than describing it as one that has a 30% chance of loss. Now, obviously, it's mathematically the same thing, but the whole point of this discussion of behavioral biases is that when we talk about the way that we interpret investable information, there's more than just the math going on. Feelings and the way that we sort of envision things in our minds, that has a lot to do with it as well. So the way that you frame an investment proposition can actually drive your reaction to it. Regret avoidance, the idea that people are less likely to feel bad about being wrong if essentially they see that others are wrong also. Sort of misery loves company sort of thing. This actually was published in the GF in 1987 by DeBont and Thaler, and can explain some of the market anomalies in the sense that investors may be more comfortable owning certain types of firms, such as big growth firms, than they are small value firms, simply because there's going to be more investors that are in the same boat with them in big growth rather than in small value. So, as the saying goes, nobody ever got fired for buying IBM. If you did enter into a money-losing position in a big growth firm, well, you won't feel too bad about it because you know that a lot of other people lost money as well. It doesn't seem like you are the outlier. Whereas if you took a position in a small value firm and you were one of a very few shareholders that lost, then you would sort of feel like somehow this pain of losing was much greater because it wasn't shared among other investors. So regret avoidance may then cause people to overbid for the types of firms that everybody else considers to be good investments and underbid for the rest, driving some of these premiums. Now, self-attribution bias is the idea that people will, sort of related to resulting and overconfidence, attribute successful outcomes to their own skill and blame the unsuccessful ones on bad luck. In other words, an investor who actually beats the market at one point will likely start trading more because now they think, oh, well, I beat it because of my skill. But if they actually didn't have that skill but are simply relying on the idea that they have it, that will, of course, lead to poor performance in the future and may explain the underperformance of some finance professionals or retail investors. The disposition effect is the idea that investors are more likely to sell their winners than to sell their losers, because similar to regret avoidance, they don't really like to acknowledge certain types of failure. So if you have a paper loss, you may not want to sell those positions simply because you don't want to make the paper loss a reality. Whereas if you have a winner, you actually may want to sell it simply because you actually want to capture whatever winnings you have had. And this type of behavior can then actually explain the momentum anomaly, because investors are then more likely to sell assets after good news when there's been some positive momentum. They can then feel tempted to sort of lock in a profit, and less likely to sell after bad news, because then there's more paper losses that they don't necessarily want to make real. Of course, at some point they will have to. They simply wait or choose to postpone it. But what this produces is underreactions in both cases. In the case of good news, there's too much selling because investors will want to lock in profits and sell the winner, which means that the price of the firm that has received good news doesn't jump quite as much, perhaps as it should. And the price of a losing firm that has experienced bad news won't fall as precipitously as it perhaps should, because again, investors are reluctant to sell that firm perhaps as aggressively. So you can see how some of these biases can actually drive the anomalies that we see in the markets, even if the information actually is correct. The markets can be efficient in a sense, but prices can simply be distorted by the psychology of investors. Now, mental accounting is a sort of bias that, in a way, contradicts the most basic idea of finance and money in portfolios, is that money is fungible. In other words, a dollar is a dollar no matter what you might have it earmarked for. But a common bias that plagues retail investors, probably more so than institutional ones, is the idea that they do sort of earmark both sources of financing as well as uses of, which may lead people to, for example, put money into a savings account and neglect to pay down the really high cost credit card loan, or perhaps be really conservative with a part of their portfolio that they have sort of earmarked for an important purpose like housing purchase, and then be perhaps far more liberal and therefore perhaps risk-seeking with another portion that they think is for something less essential like a luxury purchase. And I mean, that can work in some senses. It's not a terrible bias in the sense that it does perhaps get people at least to be conservative with some of their investments. But at bottom, it just misses out on the idea that really their entire investment portfolio is probably better off optimized as a whole for a certain specified level of risk and return, to ensure whatever outcomes they actually do desire, and any sort of sub-segmentation of it and treating certain pots of money as separate one from another really just leads to under-diversification and suboptimal financial decisions in terms of overall risk and return, after all, on which the final outcome will still be evaluated. So, for example, money that comes from a job, someone may be more liberal with because they think it's sort of a renewable resource, whereas money that comes from an inheritance, they may be more risk averse around since they don't think they'll get that again. But really, again, money is just money, and the best way to approach the management of it is to treat it as an integral portfolio rather than try to subdivide it. And a related one to this is the house money effect, the idea mostly then related just to prior winnings from investments, that with that too, investors sort of earmark it as money that they've already won and are therefore somehow less risk averse about, since it's sort of like found money, if you will. That's something they are more sort of willing to take higher risks with. But again, it really is not a rational way of approaching it, since money is money. It doesn't matter whether you earned it, inherited it, or made it as a return on investment. You really should treat it all the same to sort of manage it most rationally. But one reason that this type of approach can actually give rise to a financial market anomaly that we've seen before is that if you think about momentum, that generates a certain amount of at least paper gains once a firm starts appreciating in price. And therefore, if investors are actually susceptible to the house money effect, they might then view these paper gains as something they're more willing to keep risking. So maybe then they will actually invest even more of their money from other sources into this investment, because now overall their risk aversion has fallen, because now they have this extra paper gain over which they are less risk averse. So in other words, paper gains can then sort of keep, at least for a while, be getting further paper gains as investors pile more and more of their capital into a certain trade. Now, loss aversion is perhaps one of the other really big contributions of behavioral finance theory, and that's an outcome of the broader idea of prospect theory, also by Kahneman and Tversky. The idea that actually people will treat gains and losses differently, one from the other. And this, of course, contradicts what we've generally been assuming about investors, which is that investors are always risk averse. They have a concave utility function, and therefore they would rather have a certain thing than some uncertainty. As you can sort of see, the expected value of any two midpoints on a concave function is going to be below whatever the value of the function actually is. So you would actually rather have the value of whatever your wealth is rather than the potential of either higher or lower wealth than expectation. So what prospect theory suggests is that that's really only true for gains. So investors are risk averse over gains. So for example, if we draw a couple potential outcomes, a smaller gain and a larger gain, we could see how if we sort of just draw a line between them, that falls under the utility of wealth function. And so that we can see that then the utility of the average gain is actually more than the average of the two utilities. In other words, you're better off with certainty of the expected value of the gain, the utility of that, than you are with the expected utility of either the gain that is small or the gain that is larger. And the main contribution of prospect theory through experiments and questionnaires is to show that actually investors, and really all people, are only risk averse over gains. And when it comes to losses, their utility function actually look quite the opposite, like the shape down here over negative changes in wealth. And here we actually see the opposite, right? Here, if we look at an investor who's contemplating a small loss and a big loss, if we draw sort of a line between these, we can actually see that the utility of the expected loss, where we would be on the utility curve somewhere in the midpoint, is below the expectation of the utilities of either the big loss or the small loss. So in other words, this investor would actually be happier when it comes to losses to take a risk and either get the utility of the big loss or the utility of the small loss. In expectation, they'd be better off at this midpoint than they would be under the utility of expected losses. Why might this be? Well, it could be that people simply recall losses more vividly than they do gains. But what this actually means for financial markets is that if an investment is a loss, then investors may actually be willing to take more gains to try to break even, as it were, to try to maybe get this smaller loss outcome than the bigger loss outcome. And that, again, means that investors are more likely to hold on to their losers. That can also then produce momentum through an underreaction. Now, also sort of people's feelings have something to do with the way that they invest. So if affect, the way that an investor actually feels about the firm that they have selected, can actually also shape how much they would consider to be the fair value of the financial assets of that firm. So one finding from behavioral finance is that the more admired firms underperform the less admired firms. And that's driven by the fact that the price of the admired firms is actually bid up much more so than that of the less admired ones, therefore making their expected returns lower than those of the less admired firms. And this, of course, also has implications for ESG investing. Essentially, of course, when we think about valuation and portfolio theory and risk and return, we shouldn't really let the way that we feel about certain investment opportunities bias our valuations of them. But unfortunately, it's an inescapable part of human psychology, and that can then lead to overvaluation of positive affect firms, undervaluation of negative affect firms, and that can then drive these sorts of repeated patterns, again, even if the information set does fully contain all the information necessary to price the firms efficiently. And related to this is familiarity bias, the idea that people tend to invest in things that they are familiar with, not necessarily because they have a true informational advantage in those things, but it does seem that people somehow feel more comfortable investing in the financial assets of firms that are perhaps local to their city or state or country. And again, that's not necessarily because of any informational advantage that they may possess, but more like a familiarity, a feeling. But the problem, of course, is that feelings aside, this also will lead to under-diversification, because you could probably find less correlated assets outside of your locality, and if you ignore them, you are giving up a potentially substantial chunk of diversification. So these are the sorts of biases that shape investor behavior, and again, these are the sorts of things that can cause deviations from price efficiency even in the presence of all necessary information to make prices efficient. And that's sort of what makes behavioral finance an exciting and still very much developing field in trying to reconcile the persistence of market anomalies and predictable price changes with the substantial degree of market efficiency that we do observe in other cases.